This is Bloomberg Markets. I'm John Ehrlichman. Well, there's been no shortage of conversations on commodities this year. Russia's invasion of Ukraine, sky-high inflation, and now recessionary talk. We've been watching a roller coaster ride in markets like oil and copper, and certainly a lot of people curious about the road ahead for gold. Let's talk to someone who's spent his career navigating these waters, Canadian mining industry legend Pierre Lassonde, the co-founder and chairman emeritus of Franco-Nevada. Pierre, nice to have you back with us here on BNN Bloomberg.
Thank you very much.
Let's just start with the economic environment. This now seems to be a market that is anticipating a recession as central banks raise rates to fight inflation. What's your view?
You know what? I think it was Mark Twain who said that history doesn't repeat itself, but it often rhymes. And when I look at what's happening today, I can see some very definite parallel to what I've lived through in the 1970s. And you may remember that we did get a recession mid-1970 in 1974-76, mostly because of the increase in oil price between 1971 and 1974. The oil price more than tripled, and that set the world into a recession. And the gold price actually was cut in half at that point in time. Now, the fact is that it went from $35 to $200, well, $190, and then it dropped down to about $90 for a couple of years. And then in 1976 through 1981, it went from $90 to $800. So I think we're in the same phase of the market at this point in time. I think we're looking at early 1974, if you want a point of reference. You can see gold is having gold in a recession doesn't do well. Consumer demand falls off, and the investment demand also falls off. So, and on top of that, we've had the China lockdown have impacted the physical market quite a bit because China is the largest gold market in the world on a physical basis. So all of that has impacted the gold price. So right now, what I'm looking at is a lower gold price. Will probably test the 1684 number. And I think if you look at the gold equities, they've already discounted 1684. And so the gold equities are already beaten up. They've beaten down like you have never seen before. And then I think we're going to have we have record USD compared to everything else. So we're going to have record deficit. And at some point, the dollar is going to turn around, which it did again in the 70s. And the gold price will then reach new highs. That's where it seems to grow.
So watching the price of gold, short term and longer term, as you mentioned, possibly moving towards the 1680 level. Just to come back to, since we're looking at history as well, how central banks navigate through times such as this one, Pierre. We are likely getting another interest rate hike in this country this week. Many are expecting the Bank of Canada to raise rates by 75 basis points. What's been your general assessment, for example, of how the bank has handled inflation so far?
You know, the central banks will never be able to, it's inconceivable that they will raise interest rates to the point where real rates are going to actually be positive. When you look at the embedded inflation rates that we have today, they would have to raise rates over 5-6% to even start to be close to neutral. And there's no way that the economy can take that. So when you look at, they can talk big, but the reality is that even a 75 basis point is not going to do anything. The real rate of interest is still going to be massively negative.
I do also want to get your outlook for oil. The recession fears have taken some steam out of prices, many still pointing to what Russia's retaliatory actions towards Europe may look like and how that further impacts the supply picture. You already talked about some of those history lessons with what's happened to oil back in the 70s. Do you have a general sense on where you see oil prices going?
Much higher. What the world doesn't understand is that the oil infrastructure that we have now has been, for the past 10 years, starved of investment. And the entire world of the oil world is absolutely at the maximum capacity. There's no spare pumping anywhere. You know, Biden went off to Saudi Arabia to get them to raise their pumping rate. They can't. It's not that they don't want to. They can't. Everybody has reached their limit. And when you look at shale oil, shale has passed its peak. Okay, and they are going to have massive amount of trouble to even keep production where it is, and it's only going to happen if we're going to have investment in the world of oil. And yet, you know, for the past 10 years, we've been told ESG, okay, you don't need oil anymore. Well, I got news for you. You need oil. The world oil consumption is going up, and it's hitting maximum capacity. So the war in Ukraine has just accentuated this problem. It's not created the problem, it's accentuated the problem. And if we take Russia out, it's 10% of the world production. You're looking at $200 oil.
$200 oil. Obviously, lots of different expectations out there, and we're continuing to watch that. You know, one other development I wanted to get your perspective on, in the energy industry, we saw a big change at oil giant Suncor. Mark Little's leaving that firm after another death at one of its sites last week. That's at least. You say to those who are trying to better understand at this very busy time for the commodities industry, what goes into ensuring employee safety in the industry, as someone who's been, you know, on the front lines of the mining industry for so many years?
You know, safety for the employees, whether it's mining or oil and gas, starts at the very day the first employee comes in, or the new employee comes in, and it has to be drilled in. It has to be part of the culture of the company from day one and in the entire company. And when you have, you know, a death, that should not happen. It's because somewhere along the line in that company, there's a link missing. There's you know, something that's missing in terms of corporate culture and safety. It should not happen.
Pierre,